All right, let's talk about one of the most fascinating minds in the private markets, Jeremy Giffon. I'm not sure, are you similar? Like, I read and listen a lot, and this episode with Jeremy Giffon, which I listened some time ago from Invest Like the Best, I was like, okay, what did just happen? And then I took another episode. Then I started following some of his tweets and ideas, and I was really amazed. Like every time I'm reading something or I'm listening something what Jeremy was saying, I was like, okay, I want to learn more. And that is pretty much the result of this research I did on him. I sent him a message as well, invited him to the podcast. He said he doesn't do them anymore. He's too busy running his business, running his fund, doing deals. Totally understandable, maybe in the future. But I also said to him that I will be doing this research on him, and I will post a solo episode of the lessons. And he said that's totally fine. So yeah, this is the guy who really got me thinking, and I'm extremely happy that I'm 31 and not 51, because I believe this one research which I did on him made me a better investor. And even more importantly, the deals I'm looking at and trying to do, many of them, I'm not even spending time on them because they weren't good enough. And I can even say that before doing this research, there was an old Mick, and now post research, getting those new ideas on how to look at businesses, how to look at overall opportunities when it comes to investing in traditional profitable cash flow businesses, it changed, and it changed for better. And that's why I'm saying, like, I'm extremely glad that I found it when I'm 31, not when I'm 51. So this fascinating mind, Jeremy Giffon, and I would even call this episode the hidden genius of Jeremy Giffon. So you might know much about him because for years he stayed behind the scenes, executing brilliant deals that most people never even see. He's not out there seeking attention. He's in the background, quietly spotting inefficiencies, solving coordination problems, and making a ton of money by understanding human behavior better than almost anyone else in investing. Giffon was a general partner at Tiny, a holding company that buys and holds internet and technology-focused businesses. And the founder of Tiny, Andrew Wilkinson, he was on the podcast as well. So before that, Jeremy was on the founding team of MediaCore, which got acquired by Workday. But none of that is why we are talking about him today. We are talking about Jeremy Giffon because the way he thinks about business, the way he thinks about investing, and the human psychology is another level. And this is the guy who doesn't look at the business and ask, how can I make this better? He asks, why does this opportunity exist at all? He's an expert at identifying mispriced assets and inefficiencies that most investors overlook. One real-world example is how he was spoken about acquiring businesses where the owner was forced to sell due to structural constraints, such as when a founder's personal life, divorce, estate issues, or health creates a rare buying opportunity. He's a master of special situations where capital constraints, founder fatigue, or structural market shifts create asymmetric opportunities. And in one podcast, Jeremy discussed the case of a startup that had raised too much venture capital and was unable to meet investors' expectations. While VCs saw it as a failure, he saw a profitable business hidden under layers of misaligned incentives and restructured the company to operate efficiently without outside funding. And another interesting thing about him is every time he does a deal, he and their team pretty much say to each other that, okay, that can be the last deal we ever did because it must be so good, and it has been so good most of the times. So the next deal, which comes up in the future, it must be even better. So such a great mindset to have, that every deal you close, you're done. You can relax. You did a great job. So he's a deal maker who thrives in the blind spots of traditional finance, turning orphaned businesses into cash flowing assets. A great example is how Tiny Capital, where Jeremy was a key figure, acquired profitable but neglected internet businesses from large corporations that saw them as non-core assets. These businesses, while overlooked by their original owners, became cash machines when placed under proper management. And Jeremy is someone who understands that the best investments aren't necessarily the biggest, just the ones with the highest potential upside relative to risk. So today we are going deep. I'm going to walk you through all the lessons Jeremy Giffon has shared, but I'm not going to just list them out. We are going to feel them. We are going to live inside his brain. By the end of this short podcast episode, you'll understand how to see investments the way Jeremy does. So let's dive in. He has said, the perfect business. What if you could speak money into existence? Private equity firms and investment groups all define the perfect business differently, depending on their strategic goals and investment thesis. For example, Blackstone, the world's largest alternative asset manager, often looks for businesses with high recurring revenue and strong pricing power. Their 2007 acquisition of Hilton Hotels for $26 billion is a classic example. By restructuring the business and leveraging its global presence, they turned it into a massive value creator before taking it public again in 2013. KKR, another private equity giant, often pursues businesses with strong operational improvement potential. Their investment in Gardner Denver, a manufacturing company, was a textbook leverage buyout where they focused on improving margins and operational efficiencies before successfully exiting. Berkshire Hathaway, on the other hand, prioritizes long-term cash flow stability and simple businesses. Warren Buffett famously bought See's Candies for $25 million back in 1972, not because it was growing rapidly, but because it had incredible pricing power and brand loyalty, making it a compounding machine over time. Every firm has a different idea of the perfect business, but Jeremy's approach stands out because it focuses on asymmetry, finding businesses that others overlook or misunderstand, and extracting value through simplicity, leverage, and access. Jeremy's idea of the perfect business is very simple. You get paid an absurd amount of money for your words alone. No inventory, no logistics, no capital expenditures, just wisdom that people will pay millions for. Think about old school merchant banks, think about Lazard, think about Allen and Co. This is a business model based entirely on leverage. You don't need to invest in factories or hire thousands of employees. You just need people who trust your judgment so much that they'll cut you a check just to hear what you think. And the best part, these businesses don't just generate cash, they give you access. If you're in the right rooms, you are not just advising on deals, you're investing in them too. You're compounding inside the machine. A great example of this is the rise of merchant bank like Allen & Co., a firm that has spent decades embedding itself in the most elite business circles. Rather than just advising on deals, they take equity stakes and get seats at the table, ensuring they benefit from the upside. Another example is how Sam Zell, the legendary real estate investor, used his network to consistently access off-market deals that no one else saw. His philosophy was simple: be where the deals happen and always have the capital to move quickly. Jeremy once tweeted, the highest leverage business is being a trusted true partner to people who control capital. That's it. That's the entire game. Again, the highest leverage business is being a trusted thought partner to people who control capital. This business model is so powerful that very few people will ever have access to it. But if you get there, it's game over. In Jeremy's opinion, the perfect investment, coordination problems are where the money is. Jeremy doesn't invest like most people. Most investors focus on assets, the business, the product, the financials. What does Jeremy do? He focuses on the circumstances around the deal. He doesn't ask, is this a good business? He asks, why is this available to me? And that's the key. If a business is up for sale, there's a reason. Maybe the founder is getting divorced. Maybe the VC firm needs to clean up their portfolio before raising their next fund. Maybe there is a tax law change coming that forces an owner to sell. Jeremy tweeted, I want to buy from forced sellers, not willing sellers. You don't need to be a genius about the product. You just need to understand why this opportunity exists and whether you're the person who can unlock the bottleneck. A great example of this is when Jeremy described the deal where he bought a niche software company that had been neglected by its corporate owner. The product itself was solid but had been underfunded and mismanaged. Instead of diving deep into the technology, Jeremy focused on why the business was being sold. The parent company wanted to streamline its operations and was shedding non-core assets. This was an opportunity for a buyer like Jeremy to acquire a profitable business at a steep discount, simply because it no longer fit the seller's strategy. By stepping in and providing minimal operational improvements, he unlocked substantial value without needing deep product expertise. Consider legendary private market deals like the sale of Caribou Coffee back in 2012. The controlling shareholder, German conglomerate JAB Holdings, acquired Caribou Coffee for approximately 340 million as part of a broader strategy to expand its coffee empire. The prior owners exited due to shifting market conditions, giving JAB the opportunity to acquire a profitable, growing brand at a discount. Another example is how Warren Buffett acquired Nebraska Furniture Mart back in 1983. The founder, Rose Plumpkin, then 89 years old, wanted to retire but also ensure her life's work remained intact. Buffett recognized this motivation and acquired an 80% stake for $60 million, securing one of the most successful furniture retailers in America without aggressive negotiation. Today, Nebraska Furniture Mart generates over $1.5 billion in annual revenue and remains a cornerstone of Berkshire Hathaway's retail portfolio. These deals happen all the time. Health issues, retirement, divorce, estate planning, each creating a scenario where a great asset is available for reasons unrelated to its actual value. That's the kind of opportunity Jeremy seeks out. Special situations in private markets. VCs and founders speak different languages. One of Jeremy's favorite plays is what he calls ghost ship companies. Here's what happens. A startup raises too much money. They build a real business, 10 million, 15 million in revenue, but it's not the hyper-growth rocket ship their VCs expected. The founder realizes, I will never make money from this company. The investor realizes, this is a dead end for us. But nobody wants to admit it. So the company keeps burning cash, existing in limbo. And Jeremy once wrote, the best assets in the world are unloved, orphaned, and misunderstood. One of his favorite examples of this comes from the software space, where he found a company that had great recurring revenue but was abandoned because its VC backers were only interested in billion-dollar outcomes. The company wasn't failing. It was simply not a huge growth business. Jeremy stepped in, restructured operations, and turned it into a sustainable cash-flowing asset. Another fascinating example of special situations investing is what happened with Michael Dell's buyout of Dell Technologies. Back in 2013, he saw an opportunity to take the company private for $24.4 billion, restructuring operations outside of public market scrutiny. 5 years later, he took Dell public again at a significantly higher valuation, proving that sometimes the market undervalues assets purely due to short-term pressures. Another incredible case was Vista Equity Partners' acquisition of Marketo a SaaS company that had plateaued in growth under public market pressure. Vista took it private for 1.8 billion, focused on operational efficiencies and product improvements, and sold it to Adobe just 2 years later for 4.75 billion, a massive return on investment. This was a textbook case of spotting an orphaned but valuable business and repositioning it for long-term success. But these opportunities aren't limited to tech and SaaS businesses. Traditional businesses present similar special situations. Consider family-owned manufacturing companies where the next generation has no interest in running the business. A classic example is when private equity firm Clayton, Dublier and Rice acquired Hussmann, a refrigeration equipment manufacturer from Ingersoll Rand in 2011. The business was non-core for Ingersoll Rand, and CD&R saw an opportunity to modernize operations and streamline the supply chain. Just 5 years later, they sold it to Panasonic for 1.5 billion, netting a significant return. Another example is the restaurant industry, where aging founders sometimes hold on to great businesses for too long. In 2015, Roar Capital Group acquired Buffalo Wild Wings for 2.9 billion, recognizing that the chain had strong brand equity but had struggled under public market pressure. With the right operational focus and marketing revamp, Rourke turned it into a high-performing asset. This just shows that whether it's software, industrials, or food services, special situations exist across all sectors, if you know where to look and how to structure a deal. This is where Jeremy thrives. He goes in, restructures the company, and turns it into a profitable business without all the artificial VC package. Patience and selectivity. Great investors can sit on their hands for years. Jeremy once said he knows an investor who went 6 years without making an investment. 6 years, that's insane, right? But here's the thing. When this investor finally pulled the trigger, it was a legendary deal. This is the Charlie Munger approach. The big money is not in the buying and the selling, but in the waiting. Jeremy has said, if you're doing deals just to stay busy, you're going to underperform someone who waits for the fat pitch. Patience is one of the hardest yet most valuable traits in investing. A great example of this is Henry Singleton of Teledyne, who famously refused to make deals when the market was overheated but aggressively bought back shares and acquired companies when they were deeply undervalued. His disciplined approach turned Teledyne into one of the most successful conglomerates of its time. Another case is Warren Buffett's refusal to invest during the dot-com bubble. While others rushed into overpriced tech stocks, Buffett sat on the sidelines waiting for the valuations to make sense. When the bubble burst, he was ready with capital to deploy at much better prices. Even in private markets, patience pays off. Jeremy has talked about investors who wait for distressed assets, companies forced to sell due to debt maturities, personal issues, or economic downturns. The key is to wait until the seller needs liquidity rather than chasing deals for the sake of being active. So what is the lesson here? If you don't see a great deal, don't force it. The right opportunities will come, but only if you have the discipline to wait. The great story of the letter of intent, 25 million, and the Ferrari 488. Negotiation is an art, and Jeremy believes that most people fail at it because they negotiate against themselves before the conversation even begins. He points out that many people assume they can't ask for something or that an offer would be too bold, and so they limit themselves before even trying. In reality, very few offers truly offend people to the point where they walk away. The key is to make offers that others won't or can't make. A great example of this is a deal Jeremy came across where a business owner was waiting multiple offers. The person had already made tens of millions, so it wasn't really about the money anymore. Jeremy and his team noticed something very interesting. He was obsessed with Ferraris, but due to social expectations, his wife, or maybe just his own reservations, he would never justify buying one for himself. So, instead of a traditional bid, they structured the offer as 25 million and the Ferrari 488. Why not? There's no rule saying your LOI can't include creative terms. And in the end, that offer stood out because it solved both a financial and an emotional problem for the seller in a way no other bidder did. What is the takeaway? Think beyond numbers. Sometimes structuring a deal around what actually motivates the seller, whether that's a specific asset, ongoing involvement in the business, or an emotional win, can get you a deal that others miss. David Senra from Founders have said that learning is changing behavior. So studying, listening, researching, Jeremy Giffon, you want to learn like how to think like him. And Jeremy has shared few unconventional truths that define his approach to business and investing. So let's take them down with some of the examples. Jeremy once tweeted, everything good you want in life is on the other side of a single phone call that you're absolutely terrified to make. You know exactly who it is and you know exactly what you need to say. But instead, you let it haunt you for years. This underscores his belief in decisive action, whether it's negotiating a deal, reaching out to a potential business partner, or resolving a conflict. The best opportunities often come from taking that uncomfortable step forward. Many great investors and deal makers have built their careers by making bold calls at the right moments, such as how Sam Zell structured off-market real estate acquisitions through direct cold outreach to owners. So what else has Jeremy said? All general advice is bad. The best decisions are context-specific. Jeremy often talks about how rules like always buy real estate or never do small deals are too broad to be useful. Instead, he emphasizes understanding the unique variables in each deal. A great example is how he found opportunities in SaaS companies that were overlooked by traditional VC firms because they didn't fit in the typical growth at all costs model. Napkins beat spreadsheets. Overanalysis kills good deals. Jeremy believes that the best investments can often be summed up on a napkin. If you need a complicated model to justify a deal, it's probably not a great one. Warren Buffett echoes this philosophy as he was able to evaluate See's candies in minutes based on its pricing power and brand loyalty rather than the complex financial projections. You can tweet your way onto a yacht. Leverage isn't just financial, it's social. Jeremy has discussed how modern investors and operators can use internet to build relationships and gain access to opportunities they would have never encountered otherwise. Some of the great examples of internet entrepreneurs and people who have built brands and sharing their experience and knowledge are Alex Hormozy and Jeremy's former business partner Andrew Wilkinson. They've built like multi-million dollar networks simply by sharing valuable insights online. And social media gives you an unfair advantage in life. Jeremy's all over this trend. He says in the future there will be co-founders who are chief audience builders. They'll be brought into a business because of their audience. Instead of creators monetizing off ads, they will monetize by pointing their audience toward a startup that has a complementary product or a service. The bigger idea here is that posting content on internet attracts opportunities into your life. It lets you meet new people too. Well, maybe those people are on the yacht, maybe not, or maybe they are influential people who introduce you to new ideas that change your trajectory in your life. It doesn't matter. And you can use writing or talking to create a breakthrough in your life. Paying $57,000 to have a lunch with your hero. This strategy is mentioned quite a lot, but rarely anyone uses it. Yes, $57,000 is a lot of money. It might be your entire savings or yearly salary, or you might have to borrow the money from friends, family, or investors. But here's what an expensive lunch does. It shows you're serious about meeting someone that can change your life. Jeremy says, one of the founders of Tiny, paid $57,000 to have a lunch with well-known investor Bill Ackman. Bill Ackman is now the largest outside investor in Tiny, which is pretty cool. That was game-changing for the firm, obviously. And you've been lied to you on your 9-to-5 job. $4 coffees, don't buy meetings with influential people. 4 to 5 figure launches too, and it's cheaper than most people think. All you do is reach out to their personal assistant and make a large enough offer to have a lunch. If the person is already rich, you can offer to make a large donation to the favorite charity. If you're making a pro and con list, you've lost. The best decisions are obvious. Jeremy believes that if you have a debate on a deal endlessly, it's probably not the right one. Buffett and Munger concept of the too hard pile follows the same logic. If it's not a screaming yes, it's a no. Great investors act quickly when they see an asymmetric opportunity. Quarterbacks envy nobody. Jeremy explains that as a people get closer to doing the work they are truly called to, the things that make them envious start to disappear. He illustrates this by saying that when he sees an NFL quarterback, he feels nothing. No envy, no judgment. He doesn't think, that could have been me, or that guy isn't even that good. It doesn't even cross his mind. On the other hand, when he sees a 20-year-old founder cashing out for $600 million, he still finds himself rationalizing, well, he didn't really own much of the company, or that business isn't real. That's how he knows he hasn't fully eliminated envy yet. Well, the ultimate goal, Jeremy says, is to reach a mindset where everyone is a quarterback, where you can see someone else's success, acknowledge it, and simply say, good for them, that's not what I wanted to do, but I'm happy for them. Truly locked-in individuals don't waste time envying others. They focus on their own game and execute. Jeremy doesn't invest like normal people. He doesn't try to outsmart the market with complex analysis. He looks for simple mispricing of reality. He asks questions most people never even consider. Number one, why does this opportunity exist? What incentive misalignments are causing this situation? And can I be the person who unlocks this deal? And most importantly, is this worth my time? Because Jeremy doesn't just want to make money. He wants to own his time completely. So if you take one thing from this episode, let it be this. You don't need to be a genius to win in investing. You just need to see the game differently than everyone else. If you enjoyed this episode, share it with someone who would find it valuable, and let me know if you want to see more such research type episodes. And if not, that's fine too. I will do them anyway. So, okay, thanks a lot for listening, and remember, the best opportunities aren't found, they're created. See you next time.